Welcome back. You're still with us on Markets Today. Well, let's run you through the rest of the headlines that we're tracking for you. Which brings us to the fourth headline. Lupin was up in an otherwise wobbly market. This after the company's margins and the US sales showed a bit of a recovery on a sequential basis. Ekta's with us to tell us what got the street excited about these set of numbers. Ekta.
Well, definitely a recovery in the US business as well as margins, which is what enthused the investors when it came to Lupin. Remember that Q1 FY23, the margins came in at around 6%. The US markets disappointed with sales of around $121 million. But the company had indicated that they would see a recovery in Q2. And that's exactly what has come about. And hence, investors are enthused by it. Now, in terms of the revenue, that was largely in line with estimates. It was a flat performance. The street was anticipating a flat performance. Margins came in at close to around 11%. The street was anticipating 10.7%. So in line with estimates and better than that 6% that they reported in the previous quarter. US sales improved all the way to around $159 million versus estimates of $155 million and versus that $121 million in the previous quarter. And hence that was a positive. Profit missed estimates, but the street was really squarely focused in terms of the margins as well as the US business performance this time. Also, India was sluggish, so it was higher by only around 3% on a year-on-year basis because of its diabetes portfolio underperforming in the Indian markets. Important triggers for Lupin going forward, whether or not they manage to sustain margins in double digits. They have guided that if things go well, they could probably see an exit margin run rate of around 17 to 18%. US business sales, whether they sustain at these levels and whether they can even grow to $200 million, something that the street would probably take with both hands. And the launch of key drugs such as inhaler Spiriva, which is slated for the second half.
Q1 results were impacted by some stock corrections that we took. And that being done, you'd expect some normalcy to creep in insofar as sales are concerned in America. That was undoing insofar as the first quarter is concerned. Going forward, we think things should only pick up. We have a tight leash on costs, as is evident from the numbers itself. When it comes to, in fact, the SG&A spends, or for that matter, the workforce planning as it reflects in our manpower costs and the like. And the newer products, as and when it is brought into the market, that would also impact the overall results. So things are looking better. We had guided for the second quarter being better than the first quarter, the third quarter being better than the second quarter, and so on. So successive quarters would certainly look much better.
Business bounced back on, due to also the correction that we had taken in Q1. So there was that impact, but strong growth across both the baseline business as well as the respiratory franchise, in particular albuterol. So albuterol, we continued to grow our volumes. Combination of both albuterol as well as the baseline products helped grow the business. We also had a couple of new product launches. We had Suprep out of Somerset and a couple of other smaller products with the Goa clearance earlier this year.
Well, focusing on another one, Piramal Enterprises was down 9% after reporting a loss of over 1,500 crore rupees as stress assets weighed on the company. Abhishek Kothari joins us to run us through all of those details. Abhishek?
When you report a net loss, this is what the street will reward you, right? So, to begin with, Piramal Enterprise in their financial services business have reported a massive loss of 1,537 crore. This is on the back of the fact that stress assets have weighed on the performance. So, provisions are at 3,300 crore plus, which compares to 122 crore in the previous quarter. Now, interestingly, rupees 5,888 crore worth of book has moved from stage 1 to stage 2, which is like, overdues which are more than 60 days but below 90 days. In that, you have seen an inflow of about 5,900 crores. So they are large and lumpy accounts. Management has mentioned that it can expect some of these books to turn into NPA. So from stage 2, they can go to stage 3, which is overdue of more than 90 days in the coming period. Retail disbursements were strong, up about 21% YOY. However, AUM declined by 4.8% YOY and about 1.25% sequentially, given the fact that, wholesale book has declined both YOY and quarter on quarter. So we have CLSA on Piramal Enterprise. They have downgraded the stock to underperform from buy, and the target price has been reduced to 900 per share from 1170 that they had earlier. They say that, there is another big provision hit on the wholesale loans. So this 3,300 crore worth of provision actually compares to 1,100 crore of provisions done in last 2 quarters. Worst may be over, but investors won't digest this. Back to you.
Okay, thanks a lot for that, Abhishek. Well, Pidilite as well ended flat after a weak set of numbers in the second quarter. Higher raw material cost hurt margins and profitability. Mangala Malu's with us to fill us in with a quick analysis. Mangala?
Well, Pidilite numbers are weaker than expectations, and that's primarily on account of higher raw material costs, which have hurt the company's EBITDA as well as the net profit. If you just take a look at their gross margin as well, that has been lower both quarter on quarter as well as year on year, and is one of the lowest that we've seen in the last many years itself. As far as the numbers are concerned, revenues just above 3,000 crores as against street expectations of under 3,100 odd crores. Margins have been a big miss, 16.6% versus expectations of 17.5%. Remember, the company's overall long-term guided band is 20 to 24%. So there should be some doing for the company to go ahead and scale back to those margins, and as a result of which the net profit declined year on year and has been much lower than the street expectations as well. Consumer business volume growth has just been 1.2%. The street was working with low single digits, but this is below that as well, and overall volumes have grown in marginal positive terrain, so that would be assuming sub 1% itself. Now, the gross margins at 41% is the lowest that we've seen in the last many years, if not the lowest ever, and to that the company said the input costs this time around have been at all-time high, and while margins have been impacted by raw material inflation, high price inventory and volatile forex too has impacted them. For demand, urban has grown faster than rural, so this is a trend we need to monitor going forward, and softening of commodity costs as well as their key material, raw material, which is VAM, has seen some decline. So the second half of this year will be extremely crucial, so management commentary is something that we'll be watching out for. On the back of that, brokerages with the limited numbers that we have so far have negative views on the stock. Macquarie has an underperform call with a target price of 22.50, whereas Goldman Sachs too has a sell call with a target price at 22.50 itself.
Raw material prices have started softening and softening significantly. VAM is now down to between $1,200 and $1,400 a ton. We will see some impact of that in quarter 3, but we will really see a flow through of that in quarter 4 because, right now, obviously, you will also have high priced inventory, which you will consume in quarter 3. So overall, if you ask me, by the time we are in quarter 4 and by the time we exit this year, we will be back to a situation, hopefully, of greater normalcy. And our focus will be on the traditional Pidilite focus of volume growth.
Well, another one was down. Oberoi Realty, it was down close to around 3.5–4% by the time we wound up. The company said that it would hold an EGM, that's an extraordinary general meeting, on the 1st of December. They'll be discussing the purchase of one or more residential premises in the project 3060 West. Now, Sonal Bhutra joins us to tell us why the street was disappointed by this. Sonal.
Oberoi Realty was in focus today on the back of an announcement that the company made post-market hours yesterday. They are going to be holding an EGM on 1st of December where they will consider purchase of one or more residential premises in the project 360 West, where they have a 32% stake in that particular project, and this will be from a related party, that is Oasis Realty, and the overall consideration for this transaction will be 4,000 crore rupees. Now, Jefferies wrote a note on that where they say that the listed company owns 32.5% stake in this project, and project has substantial unsold inventory of around 13,000 crore rupees. They expect this to lead to a net cash outgo from Oberoi Realty to the tune of 1,500 to 2,000 crore rupees, and it will lead to doubling of the debts. That was the big worry. However, net gearing again at comfortable levels of 0.25 to 0.3 times. The board resolution indicates that the payment could be spread out, so that gives some comfort. Financially, according to Jefferies, Oberoi should enjoy a higher proportion of future price rise in the project, but some questions, they remain unanswered, something like the quantum and the timeline of this cash outgo that we are talking about, and the funding of this consideration as well, because debt from these levels will rise.
Hang on, Sonal. Tell us about Deepak Nitrite. Well, that was down close to around 10% after it failed to deliver in the second quarter. Another weak quarter for the company was led by weakness in the Phenolics division. Sonal, tell us more about that.
Well, very weak set of numbers from Deepak Nitrite, and it's the second consecutive quarter where the company has not been able to do well, and that's why the big disappointment. Revenues, they declined 17%, EBITDA declined 30% on a YOY basis to come in at 271 crore rupees. Margins were down almost 900 basis points, and profits also declined 31%. Part of it was also impacted because of the fire that they saw at one of their major capacity. In terms of segments, their advanced intermediates did well, growth both on a YOY and on a quarter-on-quarter basis in terms of EBIT and revenue for the company, but it was the phenolics division that did not do well, and that is one segment which the street and the management was very bullish on. Their revenues increased on a YOY basis. However, EBIT declined 55% on a YOY basis and 45% on a sequential basis, and this is the reason why the stock is sulking so much in trade today.
Okay, thanks for that, Sonal. Well, that's about all the equity market action, but the fifth headline today deals with the cryptocurrency market. That's in turmoil. Binance, the world's largest crypto exchange, has abandoned a proposed deal to acquire FTX, which is another large exchange. Manisha Gupta joins us to run us through more on the chaos across the cryptocurrency market. Manisha.
Well, it has been a disaster, yes. 48 hours after announcing that it is looking to acquire FTX, Binance has walked away from the deal. On the 8th of November, Binance had agreed to rescue FTX and signed a letter of intent pending due diligence. Today, citing due diligence, Binance has abandoned the deal. In its statement, Binance pointed to reports suggesting that customers' funds may have been mishandled. With FTX teetering on the brink, founder Sam Bankman-Friedman has lost nearly 94% of his personal wealth, making it the biggest wealth collapse for a billionaire in a single day. The collapse of the platform's token also impacted celebrities like supermodel Gisele Bündchen, American football star Tom Brady, and basketball player Steph Curry, all of whom have a substantial amount of their wealth tied with FTX. The FTX contagion has also spread to the rest of the market, with investors wary of a liquidity crunch. Global market capital of cryptocurrencies is now below $1 trillion mark. The last count was $850 billion there. The Bitcoin is trading at a 2-year lows, and that's exactly what you have seen with other cryptocurrencies, which have continued to trade below their crucial $20,000 mark, especially for Bitcoin and the other major coins seeing cuts of more than 50% from the start of this year. Whether it is about Ethereum, Cardano, Dogecoin, Solana, they're all down, and there is simply no place to hide. Solana probably is the worst affected over the last few days. It has fallen 45% in the last 24 hours after fears that FTX sister company Alameda, which holds the token, could sell its share. So chaos across cryptocurrencies.
Okay, thanks for that, Manisha. Well, on that note, though, we'll have to wrap up on this edition of Markets Today. Thanks so much for watching.